Berkshire's earnings could land at any moment. The company still has not confirmed the timing. But the first number most people will quote is the wrong one. Last quarter, GAAP earnings per share jumped almost 120%. That jump says more about stock price moves inside Berkshire's portfolio than business growth. Berkshire has warned investors about this for years. Last quarter, operating earnings rose almost 18%. Strong at first glance. But the total has 6 pieces, and one is simply called Other. Other is not an operating business. It includes currency moves and Treasury income. A year earlier, it was nearly zero. Last quarter, it reached about $1.3 billion. Remove it, and the 5 recurring lines grew only about 5%. Not 18. 5. Underwriting also needs context. Last year's comparison included heavy catastrophe losses. Strip those out, and Berkshire says GEICO and reinsurance earned less. That is the real pressure point. Now the bull case, because it is real. Berkshire has about $177 billion of insurance float. That is policyholder money it can invest before claims are paid. Because the insurance businesses also made an underwriting profit, Berkshire was effectively paid to hold that money. Berkshire also holds about $380 billion of cash and Treasury bills. It pays no dividend, so retained earnings stay inside the company. And the business is diversified across insurance, rail, utilities, manufacturing, and retail. Only 3 analysts publish targets, so treat that evidence lightly. So the balance sheet is not the problem. The question is what Greg Abel does with it. Here is the catch. My 2 valuation lenses do not agree. The low end is about $460 per share. It discounts part of the cash pile because that money may stay idle. The high end is about $505. It uses Berkshire's traditional price-to-book yardstick based on net assets. The stock trades near $509, slightly above both. So investors are already paying for the cash to be deployed well. That is the handover question. Is the cash dry powder under Greg Abel or dead weight earning Treasury yields? The strongest counter-argument is fair. Book value understates great businesses Berkshire owns outright. And no single multiple can perfectly price insurance, rail, and utilities. So this is a range, not a precise target. When the filing arrives, 5 lines decide the story. First, operating earnings. That is the core business test. Second, insurance underwriting. Watch GEICO after adjusting for catastrophes. Third, cash. A falling balance is only bullish if Berkshire explains what it bought. Fourth, buybacks. Berkshire repurchased no shares in 2025. Then it restarted in March. It paid about $487 for the Class B shares. Under Berkshire's own rule, that means Greg Abel believed the shares were below what the company was really worth. So more buying would be a direct valuation signal. Fifth, book value per share. That updates the price-to-book lens immediately. The exact thresholds are on screen, set before the release. So here's where I land. If operating earnings hold, underwriting stabilizes, and buybacks continue, Berkshire remains an exceptional business at a full price. The risk-averse investor should wait for a discount. The risk-tolerant investor can accept the upper end of the range but should not chase a post-earnings spike. If operating earnings weaken, the case for valuing the cash at a discount gets stronger, and the downside opens. So, with all that said, thank you so much for watching, and please don't forget to like and subscribe to the channel.